안녕하십니까. LS증권 글로벌 상품 영업팀 김혜진입니다. 오늘은 특별 게스트를 모시고 2025년 매크로 경제와 원자재 경제 전망을 주제로 이야기해보겠습니다. 지금 제 옆에 계신 분은 CME 거래소의 수석 연구원 에릭 놀란 연구원님이 나와 계십니다. Eric, please share a bit about who you are and what brings you here today.
All right, yes. Well, first of all, thank you so much for having me. My name is Erik Norland, and I work as Chief Economist of CME Group, which is the world's largest and most diversified derivatives exchange. I'm based in London, England, and I am traveling in Asia for 3 weeks, and I have 1 week here in Seoul, which I am very, very happy to be back here. I think it's my 8th or 9th time here in Korea.
Welcome again, and thank you for joining us here. And we got a lot of great feedback for last year's videos. So yes, thank you for coming here. 이 두 분은 평소에는 저희 메인 스피커로 저희에게 원자재와 파생상품의 유익한 정보를 전달해 주셨는데 오늘은 이제 패널로서 이후에 에릭 연구원님께 이제 Q&A 세션과 패널 디스커션 시간을 가져보도록 하겠습니다. 네, 강승희 대표님과 조세열 전무님입니다. 인사 한번 해주시죠.
안녕하세요.
안녕하세요. 반갑습니다.
네, 그럼 이제 본격적으로 2025년 경제와 원자재 전망에 대해서 에릭 놀란 수석 연구원님께 이야기를 들어보도록 하겠습니다. Now you can feel free to start whenever you're ready.
All right. Well, thank you so much again for having us on the program. It's a great pleasure to be back here, and certainly there's an enormous number of things happening in the global macroeconomy, including a turning point in interest rates. Where almost every country in the world, with the exception of Japan, is in the process of cutting interest rates after one of the largest tightening cycles that we've had since the early 1980s. And all of this has the potential to have gigantic impacts on a variety of different markets, most obviously fixed income, but also in equity markets, currency markets, as well as commodity markets like gold and crude oil. In addition to what's happening with the rate cut cycle, one of the world's most important countries economically, China, has recently announced a stimulus package which could have a tremendous impact on a variety of commodities, including industrial metals and crude oil. So over the next few minutes, we can explore all of these different themes, and then we'll have a question and answer session. So thank you again so much for joining us. Now, before we begin, I do have to show you both the short version as well as the longer and more detailed version of our disclaimers, which essentially say that because CME Group is an exchange operator, we cannot give any sort of investment advice. But with that in mind, let's begin with the fixed income markets. The Federal Reserve Bank in the United States, early 2022 and the summer of 2023, did 525 basis points of interest rate hikes. That was its biggest tightening cycle in over 40 years. You have to go back to 1981 to see a bigger tightening cycle. But the central bank, the Federal Reserve, did cut interest rates in late September by 50 basis points, which is a pretty aggressive opening move in an interest rate cutting cycle. Now in this chart, you can see the Fed funds rate in black. And you can see what the market has expected the Fed to be at in 1 year time and in 2 year times in the two blue lines. And you can see that the market has been expecting rate cuts for a long time, but the Fed didn't deliver them until the end of September. But at the moment, the market continues to believe that the Federal Reserve is going to cut interest rates further and thinks that ultimately the Federal Reserve will bring its policy rate down to somewhere around 3%, maybe 3.25% or 3 3/8% over the course of the next 2 years. Now, one of the interesting features of the U.S. fixed income landscape is that not only does the market expect near-term rate cuts, but long-term bond yields, 5-year, 10-year, 30-year U.S. Treasury yields are significantly still below the Fed funds rate, despite the Fed having cut rates by 50 basis points. And so when you look at those 5, 10, and 30-year rates, you can see that they're way below the level of short-term interest rates in the United States, which means that the U.S. has an inverted yield curve. This is not the first time that we've had an inverted yield curve. We had an inverted yield curve briefly at the end of 2018 and early 2019. We had a more significant period of inverted yield curves back in 2006 and 2007. Now, what's a little bit unnerving about an inverted yield curve is that they often happen before economic downturns. And so not only is the yield curve inverted, meaning not only are short-term interest rates a lot higher than long-term bond yields, but we have the steepest inversion of the yield curve that we've had really in many decades. Now, if you look back over a longer period of time at short-term rates, the Fed funds rates in black, and then 5-year, 10-year, and 30-year U.S. Treasury yields in the various shades of blue, you can see that we have had quite a number of yield curve inversions over the years, including in the late 1980s, the late 1990s, and in the year 2000, as well as in 2006 and 2007. And all of these periods were eventually followed by periods of economic downturn. But often it took a long time for those downturns to materialize. So for example, if you look here at the yield curve in blue versus the GDP growth rate in black, you can see that, for example, we had a yield curve inversion back in 1979 and again at the end of 1980 and early 1981. Back then, the lag time between yield curve inversion and policy tightening and the onset of recession was fairly short. It was only about 12 months. Since the 1980s, the lag time between monetary policy and the response of the economy has grown a lot longer. So for example, we had that yield curve inversion in 1989. Roughly 2 years later, we had a recession that started in late 1990 and mainly occurred in 1991. We also had a yield curve inversion again in 1999 that was followed by a recession in 2001 and 2002. And then more recently, we had the yield curve inversion in 2006 and early 2007. It was followed by the global financial crisis, which began in late 2007 and mostly occurred in 2008 and 2009. So at the moment, we have a yield curve inversion and the economy is still growing. So I think a lot of people are saying to themselves, look, the Fed tightened monetary policy. They brought short-term rates higher than long-term rates, so we have a yield curve inversion. And look, nothing's happening. We still have a growing economy, so nothing is wrong. But I would point out that when we had a yield curve inversion in 2006 and 2007, the economy was still growing at 2.5% per year. When we had that yield curve inversion in 1999 and early 2000, the economy was growing at around 4% per year. The same was true back in 1989. The recessions always happened later. So if you look at the correlation here on the right-hand chart between the shape of the yield curve and GDP growth, you can see that when you don't lag the two series, and you look, for example, at the shape of the yield curve at time t versus the economic growth rate also at time t, you find that there's a negative correlation. So basically, when you're in a period of strong growth, you often have an inverted yield curve because the central bank will have raised rates. And likewise, when you're in a period of weak growth, you often have a steep yield curve because the central bank already would have cut rates. However, if you take the GDP number and you lag it through time, you find that the correlation becomes very, very positive, especially after 2 to 3 years. So what that suggests to me is that when the central bank moves policy, it takes the economy perhaps as long as 2 years or even more than 2 years to respond to the policy tightening. And so remember, the Federal Reserve only finished hiking rates in July 2023, and they didn't even begin cutting rates until less than 1 month ago. So it's totally normal that for now, the economy is growing. Now, another way of looking at this is that over the last several decades, since the early 1980s, the Federal Reserve has been through a total of 6 previous policy tightening. So 6 tightenings before the most recent round of tightening in 2022 and 2023. Now, of those 6 tightenings, 2 of them resulted in soft landings. And we've been hearing a lot about how the US economy right now might be experiencing a soft landing. If that's true, that could be very bullish for the stock market. For example, we had a soft landing in the middle of the 1980s, and the stock market soared. At that time, the Dow Jones Industrials average went from around 1,100 points at its low in 1984 to 2,700 points at its high in August of 1987. So it was a spectacular 170% rise. We also had a soft landing in the mid-1990s. In the mid-1990s, the S&P and the Dow and the other indices did very well. They rose about 30 to 35% in 1995 and an additional 25% in 1996 before making even larger gains in 97, 98, and 99. It was a spectacular period for equity investors. So if the Fed gets this right, it could be a great period to own stocks. Now, by contrast, there were also 4 of the 6 times after those Fed tightening cycles, we wound up in a recession. And those recessions were typically pretty bad for the equity market. In 1990, for example, during that recession, the equity market fell about 20%, which wasn't so bad. But in the 2001-2002 recession, it fell by 50% on the S&P and 85% on the NASDAQ. And then in the global financial crisis, the equity indices like the S&P fell by nearly 60%. So a lot is riding on the outcome. Whether we have a soft landing or a hard landing could make a tremendous difference to the equity market. Now, what I think is important to point out here is that before those 2 soft landings in the mid-80s and in the mid-90s, the Fed raised rates, first of all, by only about 300 basis points. That was a lot less than the Federal Reserve's recent rate hikes of 525 basis points. Secondly, in those 2 cases, there was no inversion of the yield curve. So the Fed raised short-term rates, but they didn't raise them above longer-term rates. Now, by contrast, when you look at the times in which we had recessions in the late 80s, the year 2000, and in 2007, 2008, in those cases, the Federal Reserve typically raised rates more, although still not as much as what they just did, and they inverted the yield curve. And so in those cases, the recessions began anywhere from 10 months to about 17 or 18 months after the Fed's last rate hike. And so what's a little bit concerning about this is that the Fed just finished hiking rates in July 2023. That was 15 months ago. And it puts us right now in the window of time at which a recession might be at higher risk of beginning. So let's take a look at the data to see how strong or maybe not strong the US economy really is. Well, if you look at the labor market data in the US, it's kind of a mixed picture. Now, the statistics that get the greatest amount of attention from the news media are pretty strong. The statistics that get the most attention from the news media are the non-farm payrolls, average hourly earnings, and to a lesser extent, the number of hours worked. And so all of these numbers have been showing fairly solid gains in recent months, including a very strong month in September. Now, it's important to realize, though, that this is all coming from one particular survey called the Establishment Survey. The Establishment Survey is a survey of large businesses, and basically it ignores what's happening at small and medium-sized enterprises. There is, however, a separate survey called the Household Survey. The Household Survey is where we get the unemployment rate as well as the labor force participation rate. And this is a survey of 60,000 American households. And what it's been showing is that the non-farm payrolls, the Establishment Survey has been very strong, but the Household Survey, which I think does a better job of capturing what's happening at small and mid-sized enterprises, has been very weak. If you look at it up close, you can see that the Establishment Survey since the end of November last year is showing nearly 2 million jobs gained. That's very solid. By contrast, the Household Survey shows almost zero employment growth over that same period of time. So what's happening? Well, it looks to me, based on the data, that large companies are doing very well. A lot of big enterprises in the US have large reserves of cash. That cash is earning 5% invested in T-bills. Moreover, many big companies in the US also issued debt during the pandemic at very, very low bond yields. And what that allowed for was them to finance themselves at cheap rates for a long time. By contrast, small businesses almost by definition cannot issue bonds. And so they rely on bank loans in order to finance themselves. And the cost of those bank loans has increased by 500 basis points or more over the last few years, which has put small and mid-sized enterprises into a great deal of difficulty. And indeed, you see this when you look at the US stock market. For example, when you look at the S&P 500 or the NASDAQ 100 index, which are indices of large cap stocks, those stocks are trading at very, very close to record highs. By contrast, the Russell 2000 index, which is an index of small cap stocks, has severely underperformed by about 30% over the last few years, and in fact is trading down from its record highs still in 2021. And you see this also reflected in the unemployment rate. The unemployment rate in the United States has been increasing. It hit its low point at 3.4% last year and has now risen to 4.1%. But what I think is critical here is that the unemployment rate is following the same pattern today that it was following before previous recessions. For example, in the late 80s, the late 1990s, and just before the global financial crisis, unemployment had been coming down quickly, then it came down much more slowly, then it went flat, and then it began to rise before the beginning of those downturns. And so we're seeing the same kind of bowl-shaped formation, if you will, in the unemployment rate that could be an indicator of an oncoming economic downturn. Also, if you look at household finances in the US, they have deteriorated quite sharply over the last few years. According to data from the JP Morgan Chase Institute, household checking account and savings account balances peaked at around $5,500 per account back in 2021. Now that's down to just $3,000, which tells me that many American households have been spending more money than they've been earning for the last few years. And those checking account balances are now worth about $3,000, which is about the same as they were before the pandemic. But since the pandemic, prices have soared. So the actual buying power of that money, the inflation-adjusted value of that money, is in fact down quite considerably. So for example, you can see that rents in the United States have increased by 30%. Maintenance and repair costs for houses and motor vehicles have increased by 40%, and the cost of insurance is up by 50%. So all of this is squeezing household budgets. And indeed, you're starting to see large problems developing in the consumer finance sector. For example, we've seen soaring delinquency or default rates on credit card debt, which have now risen to their highest level since early 2011. The same thing is true for auto loans. Auto loan defaults have also been rising quickly and are at their highest point since the global financial crisis hit bottom in 2010. Even mortgage defaults have begun to rise in recent months, although those still remain at fairly low levels. So at the moment, if you look at the high-yield bond market, those spreads are trading at only 3% over US Treasuries. But what's a little bit disconcerting here is that often the spreads of high-yield bonds over Treasuries have widened after we have seen an increase in credit card delinquencies, which can be a leading indicator. The same thing can be true of auto loans. Those delinquencies are rising quickly and could be pointing to growing credit problems in the business sector as well. Now, the US is not the only country that's been easing policy. Essentially, every major central bank in the world except for the Bank of Japan has been cutting rates, including the Bank of Korea, almost all of the European central banks, as well as the Bank of Canada and banks throughout all of Latin America. And indeed, markets expect that in these economies, you will also see lower rates. And this is in part because in many other countries outside of the United States, we're also seeing slowing economic growth. But there is a positive side to all of this, and the positive side is that inflation rates have also been coming down a great deal. So we've seen a tremendous drop in inflation, which is great news for the world consumers. There is, however, embedded in this inflation data, a less positive piece of information. And that's that while inflation rates have been coming down worldwide, inflation rates remain higher now than they were before the pandemic. And so as a result of that, the extent to which central banks can cut rates may ultimately be limited. Now, one of the nightmare scenarios for central banks would be subsequent waves of inflation. And what I think is interesting about a long-term view of inflation is that you can see recently in 2021, 2022, and 2023, we had this huge wave of inflation in the United States as well as in most other countries. And while that inflation rate peaked a couple of years ago and is now falling, it remains higher than it was pre-pandemic. In some ways, what's happened recently is reminiscent of what happened in the late 1960s. In the late 1950s and early 1960s, we had low, stable inflation, just like we had during the 1990s, the 2000s, and the 2010s. Then in the late 1960s, we had a tremendous surge in inflation as a result of government spending that overheated the economy, much as in some ways analogous to what happened during the COVID pandemic. Then in the early 70s, inflation came down, but like recently, it didn't come all the way back down to its previous levels. And during this time, the Federal Reserve and other central banks eased policy, but they eased policy too much. And we wound up seeing subsequent waves of inflation during the later 1970s. The late 1970s, beginning in, say, 1973 to 1980, were also characterized by a lot of geopolitical tensions. In 1973, we had the Arab-Israeli war in October that year that was followed by the Arab oil embargo, which quadrupled the price of oil. Later in the decade, we had the Iranian Revolution and the Soviet invasion of Afghanistan, as well as the beginning of the Iran-Iraq war, which sent oil prices from $12 to $40 per barrel and created a second massive wave of inflation. This time around, we're seeing rising protectionism, we're seeing rising geopolitical concerns, especially with the war between Russia and Ukraine and the war between Israel and various Iranian proxies like Hezbollah and Hamas. All of this has created a great deal of tension in the global markets and could prove inflationary later this decade. Now, you can see, for example, that the shipping traffic through the Suez Canal has fallen by 85%, and already this is putting upward pressure on shipping costs across the Pacific, which have risen by around 150% over the last few months, and is causing inflation to stabilize and even to begin trending upward across many different countries. Now, another concern is we have gigantic budget deficits. In the US, the budget deficits are running at 5.5% of gross domestic product. And if you look at the two presidential candidates, both of them promise even more government spending or even more tax cuts that could potentially widen those deficits even further. And the US is not alone. If you look at other countries, Italy is running an even bigger budget deficit, 7% of GDP. France, 5.5% of GDP. Spain, 4% of GDP. If you look at Japan and China, also very, very large deficits, and the same thing is the case in the United Kingdom. So all of this is creating an environment that I think could prove ideal for the gold market. When you look at the gold market, for example, the price of gold has been soaring. So what's going on here? Well, you think about this. So governments are running gigantic budget deficits of 5.5% of gross domestic product. And they're beginning to slash interest rates. So when they cut interest rates, this makes government-issued fiat currency less attractive compared to hard assets like gold. So the price of gold just so far this year has risen from $2,000 to over $2,600 per ounce. So a lot of investors are concluding, okay, governments are not being fiscally responsible, public debt levels are soaring, and central banks are cutting interest rates, even though inflation still remains above target. In many countries, they're starting to lose confidence in government-issued fiat currencies. And it's not just the investing public that is losing confidence. It's also central banks that are losing confidence in each other's currencies. And so the reason why we know this is that every year we get reports on the net official transactions of central banks. And every year since the year 2008, central banks have been net buyers of gold. So when they're net buyers of gold, that means they're selling dollars, they're selling euros, yen, Swiss francs, British pounds in order to buy gold, which tells us two things. First, the central banks see gold not as a commodity, they see it as a currency. And secondly, they trust gold as a currency more so than they trust the fiat currencies being issued by their fellow central banks. Now, the price of gold historically has been inversely correlated to interest rate expectations. So if you look at this chart in black, you have the market's expectation for where the Federal Reserve will have its policy rate in 1 year's time. In blue, you have the price of gold. What I think is really interesting about this chart is at the end of 2018, the market believed that the Fed was ultimately going to put rates at 3%. Now, that's not what happened. In 2019 and 2020, the Fed eventually brought rates back to zero. And as a result, the price of gold went from $1,200 to $2,100 an ounce. That was an 80% rally in the price of gold. So essentially, you could argue that gold anticipated the inflation that we had later in 2021, 2022, and 2023 in advance. But when that inflation struck, central banks had to raise rates, and raising rates made their fiat currencies relatively more attractive compared to gold. So once inflation struck in 2021 and 2022, gold prices for a while traded sideways. But now that central banks have begun cutting interest rates again, gold has begun soaring. And the lower those interest rates go, especially if we have a recession, the higher the price of gold might ultimately rise. So remember, so far gold is up only 30%. Back in 2019 and 2020, it rose 80%. So there could be a lot of further upside to gold, especially if we have a recession. By contrast, if we have a soft landing and not a recession, the central banks might not cut rates all that much. And if they don't cut rates all that much, that might disappoint gold investors and limit gold's upside, or maybe even push gold prices back down. Gold prices are not only inversely correlated to interest rates, they are also inversely correlated to the US dollar. Over the last few months, we've seen a dramatic strengthening of the Japanese yen, as well as some rebound in other currencies, including the Korean won, the Chinese yuan, the British pound, and the euro versus the US dollar. So when the US dollar weakens, often that causes the US dollar price of gold to go higher as well. Also indicating that not only central banks, but also investors see gold as an alternative reserve currency to the US dollar. Now, when you look at gold versus the stock market, also a very interesting pattern. We have data on this going back to 1928. So over a long period of time, gold and the S&P 500 have gotten broadly similar returns. At the moment, the S&P 500 is ahead in that race, but that hasn't always been the case. For much of the 1930s and 40s, as well as much of the 70s and 80s, and even around 2011, gold was actually the higher returning asset over the long term. Now, if you look at the S&P 500 repriced out of US dollars and into gold, you can see a very interesting pattern, which is that sometimes there are very powerful trends where for extended periods of time, even decades, either stocks outperform gold, which was the case in the 40s, 50s, and 60s, and again in the 80s and 90s, and again during the 2010s, or sometimes gold outperforms stocks, as was the case, for example, during the 1930s, during the 1970s, and during the period from 2000 to 2011. Now, what I think is interesting here is that during periods of geopolitical instability, like during the 1930s with the rise of the Nazis in Germany and the Japanese Empire here in Asia, during the 1970s with all of the geopolitical chaos that we described after the US pulled out of Vietnam, and we had the twin oil shocks, the Arab-Israeli War, the Iranian Revolution, the Iran-Iraq War, and the Soviet invasion of Afghanistan. And again after 9/11, terrorist attacks and the US invasion of Afghanistan and Iraq, gold has been a massive outperformer. Well, we are now entering into another period of geopolitical instability. We have wars, of course, between Russia and Ukraine. We have another war in the Middle East. We have tensions in other parts of the world, including here in Asia. It's very easy to imagine that during the rest of the 2020s and maybe the 2030s, gold could be a big outperformer. Now, when you look at industrial metals, what really matters to industrial metals more than anything is their connection to the growth rate of China. Historically, copper prices and Chinese growth rates have been very closely connected. When Chinese growth rates are high, usually copper goes on to new highs and vice versa. But something has happened in recent years. China's growth rate has been very weak, and copper prices have been very strong. And I think a lot of that has to do with the energy transition. The energy transition is driving a tremendous amount of demand for copper. Also, copper supplies have been growing at a very slow rate. There's a tremendous new demand for copper, and yet there's almost no supply growth over the last decade. Now, if you look at the price of oil is also, I think, in a very, very interesting state. The price of oil, despite all of the geopolitical tensions, despite war between Russia and Ukraine, despite war in the Middle East, and despite OPEC's having removed 3.5 million barrels of oil per day from the markets, has been trading in a narrow range for the last 2 years. And at the moment, as of this recording, oil prices are only around $70 per barrel, which is way down from their high of 110. So what's going on with oil? Well, oil prices also tend to follow the pace of growth in China. Chinese growth, for example, peaked in 2007, 2010, 2017, and 2021. Oil prices in each case peaked almost exactly 1 year later, 2008, 2011, 2018, and 2022. Now China's economy has slowed down very, very dramatically, and this is weakening demand for oil. In addition to that, the Chinese are turning massively towards electric vehicles. Last year, 35% of the cars sold in China were EVs. This year, in 2024, that's expected to rise to over 50%. So all of this is weakening demand for crude oil. So I think that explains in large part why crude oil prices are weak. Another factor is that U.S. energy production has risen to a record high, which has replaced roughly half of what OPEC has taken off of the market. And of course, OPEC has a very critical meeting coming up in late November or early December. If they decide to raise production like they did in 2014, that could potentially provoke a very sharp bear market in the price of crude oil. On the other hand, if they keep oil production where it is, or if we see geopolitical tensions rise further, oil prices could reverse and start heading higher.
Okay, thank you for your insight comments. And now we will move on to the Q&A session with these two expert panels. 강승희 대표님부터 먼저 에릭 놀란 수석연구원님께 질의 시작해 주시겠습니까?
Thanks for your presentation and your opinion. So most of my question is included in your presentation already. So I give the mixed question about the equity market and the interest rate market and FX market. For example, is at the moment is the yield curve inversion is turned to the positive. and then it's moves 0 to 10 to 20 basis point at the moment. So that means it's the 1 and, as you mentioned, is 1 and 2 years. In 2 years, we can see there any recession or something like the events. So, but it's right now is a difference of the previous, the past, and now is difference is AI. So it's most of people is focused on the AI, especially equity market. That makes a big challenging for the valuation and the profitability and everything. But some of people is that is very overvaluation, but some is no. But I think it's that is makes another the war with U.S. and China. So that's why AI is focusing, because it doesn't matter for the profitability. That is a security issue, and the major currency also. So that makes it the dollar strength and interest rates and commodities all the related at the moment. That is the depending on the AI explanation. So what do you think about that? So for example, AI makes the fighting with US and China or not? That is my first question. And then that means everyone have to invest in AI, because that is not productivity and profit. That is who's the number one in the world. So that's why it makes a big tariff and all the conflict. So that makes but that means sometimes we can see the inflation because of except the China products, and then we can see the inflation, I think. So that makes cannot reach the 2% inflation rate in US. So that means long-term interest rate also is currently is of 3.5 and 4% is enough. Some of them, over the 3%. Then long-term interest rate is room for the cut down is very small, around 50 basis point, because at the moment it's 4%, and then currently is 5%. Fed rate moved down to 3%, for example, 3 to 3.5% in the Fed futures at the moment. So I'd like to know your opinion about the short-term interest rate is bottom, and the long-term interest rate is the 10-year. 10 years is target in next year.
Yeah, so let's begin with a discussion of AI, which is certainly a fascinating subject. I mean, it's extraordinary, the developments that we've seen in such a short period of time. It's almost like living in science fiction. We were told that there were going to be intelligent computers that could pass the Turing test and you could interact with them, and it always seemed never to quite happen until maybe the last 12 months, and then it really does seem to have happened. And there's clearly a race going on for AI. That there's no question about. But I think that there's essentially three financial questions here. So first, a question of equity valuation. In some ways, this reminds me of very early in my career in the late 1990s, when the internet first came about. Everybody knew the internet was transformational. It was going to be a really big thing. It was going to change all of our lives, and somebody was going to figure out how to make big profits off of it. The problem was that the first wave of internet companies mostly failed. I mean, nobody uses Netscape Navigator anymore, for example. And so we had this huge bubble in the internet stocks that eventually crashed in the early 2000s. The NASDAQ fell by 85%. Then later on, a second generation of internet companies came about that figured out how to make this profitable. And so many of those companies are still part of the Magnificent 8 stocks that have been doing very well recently. So I think the question is, from an investment perspective, is can the companies that are at the forefront of innovation in AI deliver the revenues and the investment returns to investors like the second wave of internet companies did, or will they look more like the first wave, and will they ultimately crash and burn? Then there's the question of inflation. So does AI drive inflation down by reducing the need for human labor and limiting wage growth, and therefore drive us back to 2% inflation, or maybe even to 0 or negative inflation? Or does AI use up so much resources in terms of electricity, copper, energy, silicon, other kinds of resources that it ultimately creates new kinds of inflation that we haven't thought about. And so to my mind, those are some of the major questions that still remain unanswered and we don't really know the answer to yet.
I mean, my question is focusing on the government AI because that makes most of challenging with China and US, my guess. So it's, some of them is different, is, I mean, your opinion for the government's competition for the AI investments?
Well, I think that is an interesting question. And, I would just point out that there seem to be two very different philosophies.
Yes, that's right.
So one philosophy is, you could say that the US is doing some government AI. I have no doubt that the US government is investing in this area and looking at it very closely. I'm no expert in what they're doing. But in the US and throughout most of the world, AI is widely distributed. Everybody can download the apps onto their phone and use it to enhance their own intelligence, to their own reach into computing power. There is another school of AI, though, that is using it more in a centralized way. And so it's essentially a competition between a centralized view of AI versus a widely distributed view of AI. And we'll have to see which one of those two models ultimately works better.
And the second question is for the Japanese yen, because Japan is totally separate with all the countries. So, but is after the new prime minister came in, and then everyone is expecting the Japanese yen strength because he's moving to the market follow. I mean, the fighting inflation, something like that. But later on, Japanese yen is a weakness. It's 140 to 150 at the moment. So his opinion is changing or not? Is not sure. But market is moving that way. But most of the people, I mean, including me, I think this Japanese yen could be stronger than before compared to other currency because economic data is totally separate, totally different in other countries. So do you think the Japanese yen is strong compared to others or any other currency?
Yeah, that's a great question. And so I have two entirely different views of it. I have my own view as an economist, and then I have the view that I learned while visiting Japan last week. And so these two views are very different. So my view as an economist is that it would be better for Japan to have a rather weak currency and to see further depreciation of the yen. Why? First, Japan has the world's highest level of debt. Japan's debt level for the public sector is over 200% of GDP. That's twice what France and the US have. I mean, it's really astonishing. If you added the private sector debt, it comes to 400% of Japanese GDP, which is about 150% higher than most other countries, like Korea, the United States, Canada, Western Europe, typically around 250% debt ratios. So the problem is when you have a high debt ratio, you should want to have positive inflation. When you have positive inflation, it makes servicing that debt easier and reducing the debt ratio easier because it grows your nominal GDP. So the debt ratio is debt divided by the size of nominal GDP. So the faster you grow inflation and nominal GDP, the faster you can deleverage and make a more normal level of debt. So when the Japanese yen was weakening all the way down to 160 versus the US dollar, this was providing them with some positive inflation for the first time in many decades, since the early 1990s. And it was also helping the government to reduce its enormous budget deficit as well. The problem, though, as I learned visiting Japan, is that the population in Japan doesn't really want higher inflation because it has the world's oldest population. The two largest groups of people in Japan are either around 50 years old or around 70 to 80 years old. And they have a population pyramid that looks like an upside down pyramid. So you have a lot of retirees living on fixed income. Also, the very weak yen has brought in, arguably from the perspective of some people in Japan, too many tourists. Like if you go to Kyoto, you can find every nationality in the world other than Japanese. And so I think they feel like prices are going up too quickly, and the country's being inundated with tourists who are looking for an inexpensive vacation. And it's changing their society too much. And so there's a political pressure for a stronger yen and lower inflation. So the politics are driving the yen higher versus the US dollar, where the pure economics seem to be driving it lower. And so these two forces are in conflict.
네, 다음 조세호 전문님 질문해 주시겠습니까?
Thank you for your presentation, and I'm impressed by your view on kind of gold market. So the gold has been very strong this year, and it's already risen more than 30% this year. But you think there is more potential for the upside. So actually, the central bank purchase and the Fed rate cut is already priced into the kind of current price. So the further kind of upside, there should be some more kind of things to need to be kind of factored into the price. So do you think is there any other kind of event or any other kind of factors can be priced into the gold for the upside?
Yeah, so I think you're right. So assuming that markets are somewhat efficient, the price of gold should fully factor in the fact that the forward curve is pricing an additional 150 basis points of cuts from the Fed. And so there are risks both ways. If we get a soft landing, the economy is stronger than perhaps I think it's likely to be, the Fed might cut less, and that could be bearish for gold. By contrast, if we have a recession, which I personally think is more likely, the Fed might ultimately cut rates further than what the market currently prices. The market at the moment is pricing they stop cutting around 3 3/8%. They might cut to 2% or even 1% if we get a recession, which could prove to be very bullish for gold. Also, if a new administration comes in Washington and decides that they want to cut taxes or raise spending further, and we get bigger budget deficits, that could be very bullish. Also, if a new president doesn't respect the independence of the central bank and chooses to appoint officials or pressure the central bank into lowering interest rates and weakening the US dollar, that can be very bullish for gold. And lastly, any further rise in geopolitical tensions could also be very bullish for the price of gold. So there are risks both ways, but I think that there are still a lot of upside risks.
Okay, wow, I see, impressive. Yeah. And for the second question, so the energy policy of the candidate Trump and Harris are quite different. So actually Trump pressed kind of to expand kind of oil and gas production, while the Harris kind of proposed that kind of restricting kind of production and shifting into the renewable energies kind of thing. So many people expect that the oil and gas price will go up. If Trump elected, the kind of oil and gas price will decline, but the Harris elected, the price of oil and gas will go up. So I want to hear your view on kind of those kind of.
Well, I think it's complicated, but there's a perception that the Republicans are more in favor of expanding energy production and the Democrats are against it. Yet when you look at the chart that happens to be up here on my computer and you look at the US crude oil production, most of the increase occurred under the Obama administration, who is a Democrat, and under Joe Biden, who's also a Democrat. Now, when Biden became president, he did enact a rule saying that there could be no further new drilling on public lands. It's important to realize that only about 10% of US oil production takes place on public lands. 90% is on private lands. So had that rule not been implemented, we might have an additional 800,000 or 900,000 barrels of oil per day, but it wouldn't dramatically change the production level. That would be equivalent to 0.8, 0.9% of global production. Now, there are other resources the US could potentially tap We could, for example, drill in the Arctic National Wildlife Refuge, which might eventually add maybe 2 to 3 million barrels of oil per day. If that were to be the case, it might take many years to bring that production online. And I think it might require legislation from Congress, I'm not sure. So, if depending on the outcome of the election, we might see slightly higher or slightly lower energy production, but I don't think it's as dramatic as the political rhetoric might lead one to believe.
Okay. For natural gas, so the price of natural gas kind of quite weak over this year, and the people expect that the completion of the export terminal, the kind of construction of a kind of U.S. kind of LNG terminal is going on, and is expect to be completed from next year. So after completion, so the capacity of the export will be increased to double by the 2028. So many people expect that the natural gas price will increase in the long term because of there is more demand from the overseas for the U.S. natural gas. So actually, I just want to know about your view on the natural gas market.
Yeah, I think that's right. So it's a remarkable story. Until 2016, the only natural gas that was exported from the U.S. mainly went through pipelines to Mexico. So the idea of liquid natural gas being exported from the U.S. is a very recent phenomenon. And you're right, just over the course of 2023 and 2024, we're seeing a 50% increase in export capacity. And that's going to continue to grow through the year 2028. Now, I think what this does is it causes the U.S. benchmark for natural gas, Henry Hub, to begin becoming the global benchmark for natural gas, and to begin to converge perhaps upwards towards the Japan-Korea marker price, as well as the Netherlands Title Transfer Facility, or TTF price. And so this really connects the global natural gas market together for the first time. It used to be really 3 separate markets, one here in Asia, one in Europe, and one in North America. Now it's becoming more and more of a single global benchmark with Henry Hub as its reference rate.
Okay. And last question, so for the Chinese economy, so actually the commodity price is quite kind of linked with the Chinese economy. So actually for this year, so Chinese economy was quite bad. So that's the reason why the commodity price is generally weak over this year. But recently the Chinese government announced kind of a stimulus package. So after that, Chinese stock market and the commodity price went up, but it's go down and is doing some kind of a correction. So actually, when do you expect the Chinese economy recover enough to push kind of a commodity price go high?
Yeah, and so I looked at China's stimulus package, or whatever you want to call it, and it looks to me to be very small compared to the magnitude of the issues facing the Chinese economy. You have falling real estate prices, tremendous decline in construction activity. Construction had grown to be nearly 30% of GDP. So all of this is reducing consumer confidence, reducing consumer spending, and really hitting a large section of their economy that's involved either with real estate construction or real estate finance. You look at the size of what they're doing, it's the equivalent of about 1.8% of GDP bailout of local governments, or funding for local governments. Local governments in China primarily finance themselves on the basis of land sales, so they're in deep budget trouble. Equivalent of 0.8% of GDP to recapitalize the country's 4 largest banks, sort of like what the US did back in 2008. 0.8% of GDP equivalent, allowing local governments to issue new bonds to consolidate the debts of private property developers and local banks onto the public balance sheet. What this looks like to me is a lot like what the US Spain and Ireland and other countries did after 2008. It basically takes debt from point A and moves debt to point B. So it takes debt from the private sector and puts it on the public sector's books. And what we found in Western Europe and the US after our financial crisis, as well as in Japan after the financial crisis there in the 1990s, is that it was followed by a period of very weak, slow growth. And so I think the days at which China's economy grows at 10% per year or 7 or even 5% per year are now behind us. And that China's growth rate will now permanently drop down to a much lower level, which I think is frightening news for the price of crude oil, industrial metals, and agricultural goods, because China was the primary consumer. So now all of those people selling those kinds of goods need to look for a new replacement for China. And the problem is there's really nobody there. I mean, India has a growing economy, but India's economy is about 1/5 or 1/4 the size of China. So, you know, if China slows down by 1%, India needs to grow 4% faster to pick up the demand. And so this gives, to my mind, a fairly soft outlook for commodity prices going forward, except for gold, which is sort of impervious to the state of the Chinese economy.
Okay, thank you for the clear explanation. Thank you.
Thank you.
이렇게 전문가분들이 질의응답을 해주시니까 좀 더 많은 인사이트와 생각을 들을 수 있었던 유익한 시간이었던 것 같습니다. So Erik, actually this is the end of our video. So I think it would be great for you to summarize the whole your outlook for the brief. Like what challenges we'll be watching and what challenges will might arise next year.
All right, yeah, so I think that the key challenges that might arise over the next year are, first, how deeply do central banks cut rates? If we wind up with a soft landing, they could cut less than expected. If we wind up with a hard landing, they could cut far more than expected. Secondly, what happens with inflation? Do inflation rates keep coming down, or are they stabilizing and maybe even starting to trend upwards again? If they start trending upwards again, that could also limit the kind of support that central banks can provide to an economy. When it comes to gold, does the central bank cut more than expected and therefore potentially send gold prices higher? Or do central banks cut less than expected and potentially end the gold rally or even reverse it? And then when it comes to China and to commodity prices, how successful will China be in stimulating their economy? One potential issue for China is that the last time they did a big stimulus in 2009, it was tremendously successful. But when they did that stimulus back in 2009, their debt levels were very low compared to where they are today. Total Chinese debt at that time was around 140% of GDP. Now Chinese debt is totaling across the public and private sector nearly 300% of GDP. And so will their stimulus package simply allow that debt to be refinanced and rolled forward, or will it actually add to new investment and new spending in a way that could boost commodity prices? So from my perspective, those are the key questions as we move into 2025.
이렇게 오늘 또 수석연구원님과 두 전문가분이 준비해 주신 정보들로 저희가 잘 준비하고 대응해서 다가올 2025년에는 더 좋은 투자하시길 바라겠습니다. 다음 시간에는 또 두 분과 함께 뉴스3 이슈톡 커머디티 백과사전으로 유익한 시간으로 돌아오겠습니다. 오늘도 시청해주셔서 감사합니다.